You're listening to A Book with Legs, a podcast presented by Smead Capital Management. At Smead Capital Management, we advise investors who fear stock market failure. You can learn more at smeadcap.com or by calling your financial advisor.
Welcome to A Book with Legs podcast. I'm Cole Smead. I'm the president and a portfolio manager here at Smead Capital Management. At our firm, we are readers and book junkies. It can be said that leaders are readers, and we believe books provide us a great source of information for filtering what is and isn't important for us as investors. Investing is the last great liberal art and the best way to spend a lifetime of learning. This podcast is for readers, thinkers, business-minded people, and investors who want to grow their knowledge from great authors and their writing. Charlie Munger often talks about using multiple mental models and analysis. Our aim for this podcast is to help listeners test Munger's theory in business, markets, and people. Hosting this episode with me is our firm's chief investment officer, my dad, Bill Smead. Dad, thanks for joining me.
Thanks for having me, and look forward to a great conversation.
Yeah, and this is actually a book that that Bill came across and suggested, and so we're excited to do this today. Thank you for joining us for this episode. We're going to talk about one of the greatest corners in the history of Wall Street. It harks back to the days of Jay Gould, like we just had with Greg Steinmetz in his book, and even to the Volkswagen Infinity Squeeze back in 2008. Joining us is Spencer Jakab to discuss his book, The Revolution That Wasn't, GameStop, Reddit, and the Fleecing of Small Investors. Spencer is the editor of the Herd on the Street column at the Wall Street Journal. He joined the Wall Street Journal in 2012. Prior to that, he was with the Financial Times, where he wrote the Lex column. He had a prior stint with Dow Jones as well, beginning in 2003. Spencer is a recovering emerging markets analyst from his 8 years with Credit Suisse in London and Budapest. He holds a master's degree in international affairs from Columbia University and a BA in political science from Brandeis University. He also is a holder of the New York Press Club Journalism Award that he was given in 2008 for his team's coverage of the Bear Stearns collapse. Spencer, I will start out our discussion by quoting your opening line of your introduction to your book. Quote, "I'll never forget the day I found out that my sons were degenerates." End quote. That's how you start your book in the introduction. I can assume the answer to what I'm going to ask you, but what inspired you to write this book?
Well, thank you very much. My sons actually brought the story to my attention. I mean, none of them work in finance. Actually, my oldest now does work in finance. Technically, he's a computer programmer at a fund. But at the time of this story takes place, the time the crescendo of the story takes place, he was home because of COVID from college. He was a senior in college. My youngest was a freshman in high school at the time, and I have one son in between. And he came over to me as I was editing something for the next day's Wall Street Journal the morning of January 25th, 2021, and said, "Dad, are you going to write something about GameStop?" And he usually does not ask me what I'm writing about. So I took a look at GameStop shares. I had driven him there, about 1,000 times, and his brothers, because they love video games. And, I was aware of GameStop, but by then it had been losing money for about 4 years. It was a really small company. I had edited stories about it, but fewer and fewer, because it was like Blockbuster Video a few years before Netflix put it out of business. Mm-hmm. And so I took a look at the share price, and I saw that it had doubled over the past couple of days. And I asked him why he brought it to my attention. And he said that a friend of his, was a boy who I've known since he was in kindergarten with my son, had bought the stock because he'd read about it on Wall Street Bets, which is a forum on Reddit, very particular investment forum that's kind of the star of the show here. And he had doubled his money. And I had been aware of Wall Street Bets at that point for about a year. We'd be sitting in the newsroom prior to the pandemic, and then, sitting on Zoom during the pandemic, and some stock would go up for no reason. And we'd be like, oh yeah, they're talking about it on Wall Street Bets. And it was all kind of funny to us. We had not really written about it. Most of the stocks that had gone up were of this similar ilk. They were sort of maybe even bankrupt, but not doing too well. Or, something like Nikola or whatever, things that really were not necessarily like widow and orphan type investments, although sometimes they were. And I told my son to tell his friend that he should probably sell it, because I've seen these things unravel pretty quickly and count himself lucky. And he said, no, he's not going to sell. He can't sell, which piqued my interest. And so I began reading the board, and I saw within 10 minutes of reading that something really crazy was going on and about to happen, which was that they were attempting a stock market corner, which those listeners who know anything about it, that you can't really do that anymore. You haven't been able to do that for about a century because of securities laws. But they were not doing it in an illegal way. They were doing it in a wide open way, distributed again, across hundreds of thousands of accounts. And they were discussing it on this forum that anyone could have looked at, but no one on Wall Street really bothered to look at until that day. And then it became the focus of attention. And GameStop shares became the most traded security in the world that week, and nearly put some very big hedge funds out of business, and spurred congressional hearings, as you remember. Yeah. There's a lot more to the story than that. It's a great story, and I think that the story holds a lot of lessons for investors. I learned a lot reporting it. I've been writing about finance for 20 years. I worked in a financial firm for a long time as well before that. So I thought I'd kind of seen everything, or different flavors of everything, and this was brand new to me, and I learned a great deal. I thought I understood investor psychology, and there was a whole other layer of it that I didn't know about at all until I began speaking with experts for this book. So it's I think you learn a lot from the book, and it's also a heck of a story.
Spencer, thinking of the financial euphoria books that we learn about, you make earlier reference to the Yahoo stock message boards. I think of it as the AOL chat rooms. When I was fighting against the dot-com bubble in 98, 99, I used to listen to the Motley Fool radio show to get a sense of the pulse of the insanity that was going on there. And could you talk a little bit about how this particular episode that you wrote about compares to those others?
Sure. I mean, I think if you go back to the first stock exchanges in the 1600s, you would have found some characters who were very familiar to you, and there had been books. There were books written close to the time, books written in the 19th century, many good books written in the 20th and 21st centuries about that history. You had stock touts, you had manias and panics and crashes, and I think the underlying thing is that human psychology lends itself to that. People, that's why we exist today. That's why you and I are alive, and other people aren't alive, is because our genes were shaped by our ancestors, who, when they heard a rustle in the bushes, were very cautious and would panic even if it was a false alarm, because 9 times out of 10 it was, but 1 time out of 10 it wasn't. Or when you saw a crowd rushing towards something that might be food, might be a false alarm, might not be anything to eat there, but you would miss out on a meal, and that meal would allow you to pass on your genes. So, humans are really susceptible to these things. And of course, instead of stock touts during the South Sea bubble, during the dot-com bubble, you had people on message boards touting things, or outright fraudulently pumping things, putting false information, making fake press releases, all kinds of crazy stuff. And so the internet brought a new dimension to it. And naively, I thought that this was just that on steroids. But it wasn't. There was a different dimension. Different things were going on, both in the world of how people buy and sell stocks, and in terms of how they communicate about stuff. And I'm not saying, the 4 most dangerous words in investing, is this time is different, but this time really was different in the sense that I think that people who are our age and have had our experience completely underestimated the power of social media, the algorithmic nature of social media, how it concentrates certain voices, and how it can be harnessed, and how things can go viral. And also, we failed to understand the significance of being able to trade for free, frictionlessly on a smartphone. And then a lot of other social forces that got maybe 20 million young people into the market, into things like crypto too, but also into trading stocks during the pandemic.
So since he's the central character in your story, can you kind of just give kind of a primer to Keith Gill?
Sure. I traced the story through him, and he was not the mastermind behind this plan. He happens to have made about 1,000 times his money. He's a financial planner with a CFA designation from Massachusetts. For 95% of the story, his whole social media history is laid bare in terms of what he was doing. It was probably a PG-rated show, but he went by the name Deep Effing Value on Reddit, so he was anonymous. He went Roaring Kitty on YouTube, also anonymous, didn't say who he was, what he did, but he had a CFA. So he was a very different kind of character than the most people who did this. Very different in a lot of ways. Same age. He was right in the kind of sweet spot in terms of the age, and he understood memes, and he understood virality. But for most of the time, he owned GameStop because he thought it was a good value bet. And he made a very, very extreme bet on it. So instead of just buying the stock, he put essentially almost all of his net worth into it, and not into the stock, but into call options, very long dated, very far out of the money call options on the stock. So basically a long-term bet that it would go above that level. It had to, when he first made the bet, go up more than 100%. And then he even extended that bet and the maturities and the strike price. So it was just a total lottery ticket, but he was very confident in his analysis, although not 100% confident. He really is, I could see him, if he was doing this in a different era, being a really good value investor. And that's the kind of the thesis that he had. And he was ignored. Value investor, someone who's cerebral on the internet today, is going to be ignored. And he was mostly ignored, but the people who paid attention to him on these message boards kind of mostly ridiculed him. When he would double his money, of course, options are very volatile, and then he'd see his nest egg cut in half or more, and people would say, "What an idiot! You should have sold, and I would have done this, and you should have done that." And he would just calmly and patiently explain why you shouldn't be emotional and react to things. And he wound up making a bundle. But the reason he made so much money really was in part because of him, but in part because of other people, was that, he became the mascot for this group. So as this story kind of approached its climax in late 2020 and early 2021, people noticed him all of a sudden and looked up all of his old posts and rallied around him. And he would begin posting screenshots, not with his name and account number, but screenshots of his E-Trade account with his position. And the fact that he had made so much money, and the fact that each day he would post a screenshot and he had not sold, inspired millions of people. People would just wait until after the market closed to see if he had sold. And they couldn't believe, after having made so much money, that he wasn't going to take the money and run. And that proved inspirational for people. And that was the phrase diamond hands came from this board. If you have paper hands, then you're weak, you sell. If you have diamond hands, then you hang on and you're strong. And that's what my son told me. His friend had to have diamond hands and hold on. And that's, of course, what you need to do. If you want to institute you need to do it, right? You need to hold and then just kind of hold that other person over the coals. Because for anyone not familiar with how short selling works, short selling is a totally legitimate practice. But short selling, and this stock was sold very deeply short. Short selling means that you've opened yourself up, instead of to an theoretically unlimited gain and a limited loss of 100%, it's the inverse of that. The most you can make is 100% if a stock goes to zero, if you're completely correct about it going bankrupt. But the most you can lose is infinity. And so you really better be right. And, if you're forced to buy back the stock and the stock price goes to an absolutely insane, irrational level, as it would during a classic 19th century corner where people snapped it up secretly behind your back, then you had to pay whatever price there was. Daniel Drew, the 19th century speculator, said, he who sells what isn't his and must buy it back or go to prison. That's what happened. No one went to prison, but you could take all of someone's money, and they would have to pay it to you because they had borrowed the stock and sold it, and they had to give it back to whoever they borrowed it from. So that is the situation that they engineered. The prerequisite was that everyone had to be disciplined and not sell and have diamond hands. And this guy, he didn't come up with the idea of instituting a squeeze, and it was a very particular kind of squeeze. I can go into details if you want. He was their mascot. So sure. I traced the story through him, and then I explained all along what's going on. And I wrote this book. Finance professionals found it very interesting, but I wrote it for my mom, for an educated person who really doesn't know about finance. I think I wrote it in a way that I don't get too jargony or technical, I hope, and explain it to the casual reader and explain the significance of these different things that go on in financial markets every single day with your retirement portfolio.
And to your point, I think you did a really good job of giving average people or anybody that doesn't sit in the investment business kind of an insider's feel for what went on. And so I agree with you there. One of the things I really felt when you were writing about Gil is that it was strange in that he would speak in truths, right? So for example, to your point about people were saying like, oh, you can't lose money taking a profit. And the quote you used from him was, quote, perhaps, but that's not how you maximize returns over the long term, end quote, which is like what you'd expect kind of like a low turnover stock picker to say, not someone YOLOing on deep out of the money calls on a stock that could go bankrupt, right? So there's this kind of I don't know,
schizophrenic contrast.
It's not a paradox. It's almost an irony to the virtue he espouses, and yet what he does to take his risk is as far from that virtue as possible.
It's interesting, right? Yeah, I don't think anyone else could have assumed the role that he did in this whole story, because he straddled those two worlds. So he would quote Aswath Damodaran, who's an NYU finance professor.
The dean of valuation.
So yeah, and so he's well known in our world, but he's not known at all to these people, which is one reason he was ignored. And if two people go on social media, and this is what I said about the virality of social media, we all know that things go viral, but we don't have a great understanding. And I spoke with social psychologists and social media experts and Silicon Valley people about how things go viral, and so it's by design. Different social networks have different ways of achieving it, but it's all the same. And in the case of Reddit, it's a human algorithm. So let's say, Cole, that you and I were to use our anonymous names and go onto Reddit, onto some message board. Unlike Twitter or Facebook, where we might have followers or not have followers, you could be just Joe Schmo on Reddit and post something there. And I might say something crazy like, I just took out a second mortgage on my house and I bought deep out of the money calls on this stock. I'm betting my entire, family's wealth on it. YOLO. Ha ha ha, and put a bunch of rocket ship emojis on there. And then you might express confidence in the same stock, but say, yes, 5% of my personal net worth is in this. I think it could go up, although here are the downsides, and be very cerebral about it, as one should be, because, that's the kind of the way to be, frankly. But your advice is more nuanced, right? But your advice is boring to that crowd. So it's not going to get upvoted. It might even get downvoted because you're being a dweeb, and I'm being really risk-taking and cool. And so when a third person shows up on that message board, not only will yours have been upvoted or mine have been upvoted and have risen possibly to the very top and be seen by lots and lots of people, but yours will be invisible. So your more cautious take which is the more correct take, will be invisible. And that is the kind of crowd and place that Wall Street Bets was. There are other boards there called R Investing, they're kind of Warren Buffett aficionados and Jack Bogle aficionados and all kinds of things, but not this board. This board was all about doing crazy stuff. It was like, Jackass for finance. You do crazy dumb stuff, and then it was funny, and then they embraced it. Like when people would lose money, that was celebrated too. People would post pictures of having lost 98% of their portfolio. Ha ha ha. And in a lot of cases, it wasn't 98% of a large portfolio, because remember, these were young people who were just getting started out for the most part. So they may have had $1,000 and now they had $20, right? So
to kick back to the irony to the mascot, like you said earlier, I mean, you mentioned Keith Gill has a CFA charter, which is considered the gold standard and one of the highest ethical standards, broadly speaking, in the industry. And yet that's all going on via a person with a CFA charter. So when I got done, thinking about this, I thought, and I'm a CFA charter holder myself. I thought maybe a CFA charter is just a license to kill.
Well, and ironically, to summarize the last portion of what you said, Buffett always says the market was created to move money from impatient people to patient people. In effect, Gill tried to be both an impatient person and a patient person at the same time, which is impossible.
He made 1,000 times his money at one point. I mean, obviously he was lucky too, because he happened to pick the right stock. His initial thesis, so this stock was like dry kindling, with little gasoline poured on it. It just needed a match, because the consensus was so strong that it was a loser, that it had been pushed down and down and down, and the short bets against it were so extreme that it left a very narrow window for escape. It's just that the people who were making those bets, it never occurred to them that there would be any kind of lasting squeeze. So what's the worst thing that could happen, right? I mean, someone shows up and says, "Oh, well, Best Buy says we're buying GameStop," and then it doubles in price or something, and you had a terrible month. You don't think it's going to go up 100 times or 200 times in price in a matter of months. That's just not part of your calculus, because why would it? It was just sort of like a total fat tail event, basically, except it was engineered. It was an ambush. It was done deliberately. It was discussed openly. You can go back, and I have all the, not all the passages. I mean, it would be a long book, with a lot of appendices, but the key bits are shown and summarized in terms of how they discussed it and who came up with it and things like that. And I don't know who those people are. Nobody knows who those people are, although clearly there are people on that board who knew a thing or two about finance other than Keith Gill. And he was not the architect of it, by the way. I don't think that he did anything unethical, although I think he should have maybe realized sooner what he was doing, because his actions were egging people on. A lot of money got incinerated in the late stages of the story.
inflammatory.
Yeah, Wall Street should have paid him to keep it going.
Yeah. Spencer, if the meme stock people are kind of degenerates, what does that make the fame seekers like Michael Burry and Dave Portnoy that work the other side? What are they?
Well, Michael Burry shows up in the story, the value investor who became famous through The Big Short. He was very early. He was a very successful value investor, just in stocks, and then he made early but ultimately correct and very lucrative bet against housing during the great financial crisis. And he showed up as a big shareholder. And he took his profits. Took his profits a little early, but he took his profits. And then he said, you guys are insane. He was really, and he's come out since then. His handle on Twitter is Cassandra, and then he keeps deleting his account. So he's a weird guy. But there are other people who I think did unethical things. And I've been asked a bunch of times since the book came out, did anyone break the law? Yeah, I think some people who will never know who they are broke the law. The SEC will never bother to go after them, and they were largely small fry. Did Chamath Palihapitiya break the law? Did Elon Musk break the law? Did Dave Portnoy break the law? These people were the cheerleaders who were cheering on this crowd to do dumb things in the market. Sometimes just for their psychic benefit, sometimes for their financial benefit. In the case of Chamath, it certainly was because he benefited. He was the SPAC king. He benefited a lot from his retail enthusiasm. Elon Musk, he's become the richest man on earth really because of his ability to, in my opinion, to make himself influential online. He's a stock is worth what people are willing to pay for it, and he has an aura about him. He's kind of a genius. Might be a genius in other things, but he's a real genius in terms of
promotion,
public opinion in the age of social media. So I don't think that that's very ethical to enrich yourself, or even to make yourself feel good when you're smart enough to understand that people are going to get burnt. Dave Portnoy, who said he had bought 1 or 2 stocks in his life ever, all of a sudden he came from the world of gambling, became Davey Day Trader during the pandemic.
Yeah.
And he would pick Scrabble tiles out of a bag until he got a stock ticker and do it live on Twitter to his 2.5 million followers, and then people would buy that stock. I mean, how dumb can you be? But but this is during a time, remember, from the bottom of the pandemic bear market, and this is when a lot of people got into, were young people home bored, opening up Robinhood accounts and whatnot, to a year later, 96% of American stocks rose. And the worse the stock was, the lower quality it was, the less profitable it was, the more likely it was to be in that 96%. And the more likely it was not to have gone up, but to have gone up a lot. An index of profitless stocks far outperformed the NASDAQ Composite or the S&P 500 during this period. So for a while, it did work, as long as you knew when to get out, which unfortunately people didn't.
You have no idea how much you made my day by mentioning how the media allowed these guys that were feeding the different speculative episodes and treating them like they're some kind of wealth-creating gurus. That was offensive to me after 40 years of being in the investment
Bill's
business.
beginning to sound like a boomer here, Spencer. Let's see. You do a really good job in the book also of kind of adding various studies to it on various things that were going on in different phenomena psychologically. You point out a Washington State University study about confidence and followers, and you kind of touched on it a second ago, but can you explain this relationship from that study?
Sure. Well, this was a study done some years ago where two students studying economics, they're getting a PhD in economics, like as postdocs actually, and they wanted to do a study about confidence in stock market predictions, but it was too difficult to track. So they found a lot more data, and it's the same kind of thing. It's the same psychological phenomenon by looking at Twitter. And they looked at Twitter around the time of the World Series and the Super Bowl. And they looked at billions of tweets, basically, by disaggregated strangers. And they could that you definitely can see if someone's been accurate. People will go on CNBC and say, I think this stock is going through the moon, and then the next time they're on CNBC, if they really got it wrong, they don't embarrass them by saying, hey, remember last time when you said you thought the stock was going to do really well and it didn't? They ask them about the next thing. And so you're not really, if you're a financial pundit, you're very rarely, held to your predictions. But these
Sure.
were anonymous people, and they were making specific predictions like this team will win the series in 6, or this pitcher is going to do really well, or this team's going to cover the spread. And what they found was that the more confident you were even if you were not accurate, the more Twitter followers you gained. So the more influence you gained. Whereas people who were more accurate but more cautious got a lot fewer followers. So there's similar to what we were discussing. And there are other phenomena that come into it as well. There's social proof, which is the whole Keith Gill phenomenon. If you are very confident on Wall Street bets and do the crazy thing, like the example I gave with you and me, Cole, then you'll get a lot of attention. But if I were to follow that up by then proving to you that I had made a lot of money in the past or on that thing, saying, oh yeah, I have $1 million and I started out with $1,000 and I did this and that, then people will really be interested in what I did. And that explains the Keith Gill phenomenon, because he, on paper, already at the beginning of his influence, had made many multiples of his money and had been consistently confident. And his attitude was not like a lot of the people on the board. But then he basically went radio silent with the kind of boring investing rationale for owning GameStop, because GameStop, it went from 2 to 4 to 10 to 20 to 40. At 40, it was way past what he thought it was really worth.
Sure.
And he correctly surmised that there was a short squeeze going on and there was an opportunity to make much more money. He stopped making fundamental arguments. He just started posting memes, and he was really good at it. And memes are how, that's why they're called meme stocks. The memes are how this generation that's very online on forums like Reddit, but not just Reddit, communicate and get their message across. And if you look at Wall Street Bets, you'll see it's full of emojis and memes and things like that, which are a very effective way of communicating there, and a very cool, noticeable, viral way of communicating there. So that's what he did. He changed his tune, became very influential because of social proof and because of this kind of expression of confidence. Yeah, but confidence is what matters, and confidence does not correlate with accuracy at all.
I'm going to quote the book, and one of our favorite books is John Kenneth Galbraith's A Short History of Financial Euphoria. Quote, "You need a solid grasp of human psychology, which has hardly changed in the last 50,000 years, to dissect a financial mania," unquote. We agree with this statement and believe we're coming out of a mania. In fact, Munger calls it the biggest one of his career because of the totality. What books have helped you personally understand this phenomena, and why have so few people called this what it is?
That's a two-part question. What books? So that book is one of my faves. I reread it from time to time. I've got it on my shelf. I've got Kindleberger's Manias, Panics, and Crashes. De La Vega's book, Confusiones, which is basically like an old book about stock market. I just mentioned, like, things have been written about this before. They could be describing modern times, in very archaic languages. Anything that's good about financial history, I've tried to read, because I think you need to understand that, because human nature is unchanging. Why was it not portrayed that way? So I'm in the media. I'm the editor. I write from time to time, but I'm the editor of the Heard on the Street column. I understand how stories, there's not a committee that sits down and says, how do we pull the wool over people's eyes? How do we get people excited? The way that, first of all, journalism is the first draft of history. I'm sure you've heard that, right? So the first draft is not always the correct draft. So most people, I think, who paid attention to this, unless they picked up my book or watched one of the form and counting documentaries that have been made about it, kind of stopped thinking about it soon after that time. So their whole understanding of the story came from stories and headlines and late night talk show hosts and things like that were at the time. And at the time, and I'll admit that my initial reaction to this was the same. My initial reaction, I wrote, after this, I told you the story of how it came to my attention. I wrote an email to the acquisitions editor at Penguin Random House. I just knew her name, and I figured out the email, and I got the email suffix correct. And I had been working on a couple of book proposals I wasn't very excited about. I just had them half written and thought maybe I would, that's why I kind of had her name in my head. Sure. I sent her an email and I told her this was happening. And she said, I haven't heard about that. I said, yeah, you haven't heard about it, but you're about to. Within hours, you're going to hear about this. This is a really big deal. And the reason that I thought it was so interesting was just that I didn't think that the little guy can really pull one over on Wall Street, but I thought this would be one example where they did. And it was just amazing to me that they had executed this corner, or almost executed this corner, in broad daylight, in a way that's legal, and 100 years after the last corner had ever really been legally executed in the United States, accepting silver by the Hunt brothers, right, in 1981.
Well, yeah, but often, Spencer, corners like using in the late 19th century, what followed corners was panics. And it isn't that kind of what we're staring at right now is somewhat of a panic followed by this mania.
We definitely are. I think that I'm a firm believer that it's not just numbers and lines on a chart, it's also psychology. And the psychology was so confident, say a year ago today, a year and a half ago, that because there was such a kind of a reinforcement of this buy the dip mentality and buy the shiny new thing and trees grow to the sky, that the comeuppance that we're in the middle of right now is going to be equally severe. And it's not just a matter of numbers and dollars and the Fed's balance sheet. It's also, and we have not, I'm very confident that we have not seen the bottom. We have not seen capitulation, because you have to have a real panicky, disappointing period where, people are kind of, hate stocks or disgusted with stocks, because the capitulation has to be in proportion to the mania.
You're saying is we had a nifty 50 or a mania like that, and you got to have 73, 74.
The punishment must match the crimes.
It just psychologically has to, right? Because
it
you
has
have to, because this
it has to.
It doesn't have to be 1929, and it doesn't have the economic consequences don't have to be as severe, but the emotional consequences do have to be as severe as they were on the other side of it. And so that's why I wrote a piece for the Journal back in the summer when we were in, people said, "Oh, we're in a new bull market." I said, "No, it's a bear. Clearly, every sign points to this being a sucker's rally, a bear market rally, of which you could have multiple ones. You have had multiple ones during really big sell-offs because of different things. For example, at that time, Kathy Wood's fund, ARK Investment Management, was still seeing inflows despite all the money that.
I'm glad you said that, by the way, Spencer. No one says that.
No one says that.
No one calls it a mania. No one says
she's
how weird the activity
more capital
is.
than just about anybody we've ever seen.
I was very excited about it too. So for about 24 hours, I was like, "This is a crazy story. I'm gonna write a book about it. I'm gonna convince this publisher. I stayed up, late into the night for 2 nights in a row and wrote a very, very hasty, rough pitch. But in the process of writing it, in those 48 hours, it's like, you know what? This is just like everything else. The real story here is that the little guy will end up losing a ton of money in this. And the later they get into it, of course, the more money they'll lose because they'll be buying closer to the top. And this is really just a bonanza for Wall Street. And specifically, as I tell in my story, it's bonanza for market makers like Virtu and Citadel Securities and Susquehanna, and for brokers like especially Robinhood, but also E-Trade and their ilk. This was the kind of advertising that money cannot buy. They got people so excited. This got people so excited. They always try to get people excited because activity is how they make money. But this was just you couldn't engineer a more profitable, desirable scenario for them. But as I tell in the story, it just got out of hand because of they did too good of a job basically. But I think the headlines at the time, or 90% of them were Wall Street gets a black eye, the tables turned, will things ever be the same again? And a lot of people believe that. And then the more thoughtful takes come later, and people don't read the more thoughtful take as often. But the more thoughtful take, I think, is often the correct take, right? I mean, once the dust is settled and you can stop to think about it and you're not caught up in the excitement of the moment. And I think my take is unfortunately the correct one, which is that even though there are unique elements to this, there are really different things psychologically and in terms of market structure and free trading, and frictionless apps and things like that. It's the same old story. They lost money. Rich people made more money, and corporate insiders too, by the way, in this case, rich people who are at the right place at the right time, and rich people who stood to benefit from it and just couldn't believe their luck. That's why it's called the revolution that wasn't.
So since the children of the baby boomers had happened to them through this, what we did in the .com break, explain the genesis of Reddit and the Wall Street Bets subreddit.
I think that the population of this group. So Reddit is a social media company founded by, around the same time, within a year of Facebook being founded in a Harvard dorm room. It was founded in a University of Virginia dorm room by two roommates, just like Facebook. It was much less financially successful, still is much less financially successful because it's a more difficult to monetize social medium. But it doesn't mean that it's not very influential in some groups, because it has about 100,000 subreddits. So instead of having followers like one would have on LinkedIn or Twitter or Facebook or TikTok or YouTube, it has different channels where anyone who's interested can participate and get karma and things like that.
Like a bulletin board.
So, yeah, and so I like Reddit for, not for this in particular, but like, if you want to know about some kind of arcane thing, I mean, gardening or trail running or whatever, like, you'll find like-minded strangers, and some of what they say is nonsense, of course, because it's random people on the internet. Don't bet your life. Don't you see if you're sick, go see a doctor. Don't listen to Reddit, but or something like that. But I like Reddit for that reason. I like Reddit for the exact reason that it's not that profitable, because anybody can kind of have a voice on there and throw in their 2 cents. And there's some quite kind of good boards, even for investing, by the way. But Wall Street Bets was born around the time that Robinhood was born. Robinhood was born in 2012. I think Wall Street Bets got its start right around the same time. It was very small and obscure, and it was really a place to do, where are we going to hack the financial markets? Where are we going to do crazy things? I spoke with its founder quite a bit. He's no longer, kind of with the group. He's out of their good graces. But that's what he's all about. But he was very self-aware. Jamie Rogozinski, and he really kind of explained the ethos of it. And it's interesting that the group changed, of course. Any group that you could think of, like a religious group or a political group, and there's a small group of people who found it, and then all of a sudden, for some reason, a bunch of people are attracted to it. Well, the people who are attracted to it later on very often are more zealous than the people who originally were in the group. I don't know if you found that in your personal life, but like the people who are late to something are super duper serious about it. Someone who converts to a religion is more religious than the people who converted them to that religion. And that's what Wall Street Bets became like, as it went from having a couple 100,000 people to having now 11 million people, is that the big growth in it was during this time that my story kind of reaches its apex. And those people were in it to, a lot of them, not to make money, but to hurt Wall Street. Their formative experiences were seeing their parents suffer during the financial crisis and Wall Street not really be punished. We can talk about that all we want, but they saw Wall Street as the villain. They saw hedge funds, especially on Wall Street, as the villain. Not that they necessarily understood what hedge funds are or about, or whose money they manage, which are largely like college endowments and institutions and stuff like that, and pension funds. But and then short sellers were the most evil of all, right? Short sellers were the devil incarnate, and so a short selling hedge fund on Wall Street, well, that's a guy you want to punch in the nose. And financially, they had the means suddenly to punch them in the nose, and they cost one hedge fund in particular losses of $7 billion within a matter of days. So they succeeded. But what they didn't understand is that Wall Street's a really big place. Most of Wall Street really loved what they were doing, with the exception of a few people on Wall Street who had a terrible month. When this was going on, they loved it. It was a really profitable time for Wall Street, for Morgan Stanley and Goldman Sachs and most hedge funds. It was like like shooting fish in a barrel. There was money just coming out of the everywhere, right? So
let's get to the drug dealers here. So Bat and Tenev, they start Robinhood, okay, but that's not really what they were originally doing to get out to that business model. What can you explain what they were doing prior that eventually caused them to create Robinhood?
Yeah, so they are both very clever guys. They met at Stanford University. Vlad Tenev, who's the CEO of Robinhood even today, was a PhD math student, and his slightly older friend, Baiju Bhatt, was doing some work on Wall Street, convinced him to leave, and they were helping hedge funds make more money, trade more effectively. They were kind of small-time players out on the East Coast doing that. And they had the realization that if hedge funds can trade basically for free, because stock exchanges these days are really just big, server farms, out in New Jersey or Kansas City or whatever, why can't we do that for individuals? And there already had been some people who basically were starting to offer quote unquote free trades. But they decided that what they needed to do was have a really, really cool app. And they worked for a couple of years on this, and they got a lot of buzz online, and it went viral even before it was available. Robinhood had 1 million people waiting to open accounts before they had a product. And they kept testing this app. It was voted App of the Year in 2015. It is a thing of beauty. If you look at it now, it'll look quite familiar to you, because there are a lot of other apps that have a similar look and feel, but it's very frictionless, very colorful, confetti and colors, and and very strategically chosen fonts and colors, by the way, in my opinion. This is the opinion of problem gambling experts, who know about gambling apps and know about Robinhood. And and they unleashed it on the world. And for 5 years before our story starts, from the time they got started, 1 out of every 2 brokerage accounts opened in the United States was opened with Robinhood, getting paid themselves for laying off the bets, not to a stock exchange, but to a market maker like Citadel Securities. And so the more you traded, basically, the more money they made. So they were very interested in getting you to be active. They didn't care if you made money. I prefer personally to deal with people whose interests are aligned with mine, who also would like to see me make money, not to see me be very active. I mean, their model was like the old churn and burn stockbroker model, basically.
Just with better technology. You get it, Aaron. So you mentioned in your book, and I think this is a great point, and we've talked a lot about this, Spencer, so I love kind of thinking about this. You mentioned Aaron Levy's simplicity thesis. I joke often that the investment business is 20 years behind technologically. And you can find that almost in every case, I would argue. You look at most financial websites outside of big banks, they're going to look like about 2005, for example, okay? Can you explain what Levy's simplicity thesis is? And you mentioned about the app. How much easier is it?
Yeah, so his thesis, and he's the founder of Box. He's a big investor he's an original investor in Robinhood, by the way. And I spoke to some other people who were original investors who spoke to them when they were just getting the product going. And his thesis is that whoever has the least friction in their product wins, that the more simple you can make something, the better it is. And you had 2 things going on with Robinhood. One is that it was very intuitive, especially to young people who were growing up on smartphones. It was totally intuitive. It was much better. You think about like E-Trade, which got, it's called E-Trade, right? It's not like Charles Schwab. It's not, it's not Morgan Stanley, that has decades of history. It was E-Trade. But it got started during the .com era. It's way, way better, or was way, way better than E-Trade's app, because it was really an app first. It was an app, and then they came up with a brokerage firm to attach to it. And the simplicity and the fluidity of it made it totally appealing. And it was designed, not just that, though. This is what Aaron Levy did not write about. And no one at Robinhood will really engage on this matter, or they'll kind of poo-poo it. But the app is also designed to, with all kinds of things that one sees in the gambling world. And I'm not saying, I'm just pointing this out. I'm not accusing them of being manipulative here, but I'm just pointing it out that the similarities are there. When you open the app, is it important to you to see what stocks are up and what stocks are down in a given day if you just were checking your account? It's not important, but it does induce a sense of FOMO. It's like, I'm missing out. I need to see what's going on. Ooh, maybe I can jump on this thing. And that's very much the sense that I got speaking with young people who were customers of Robinhood. That's what would get them to trade. And the fact that trading costs 0 was really significant here. Of course, we know it doesn't cost 0, right? There's a cost, hidden in the trade, because nothing's free in life.
Sure.
It can be cheap, but it can't be free. But there was $0 commission. And there's something called the zero price effect. When something fun, and people don't really think of trading stocks as fun, which is why I guess all these other brokers never threw in the towel earlier and went to $0 commissions. They only all did it in 2019, very end of 2019. And then trading exploded. They thought it was going to cost them money, and it made them money. That's what they didn't understand. When something is free and it's fun, then you'll do way too much of it. And that's kind of, the nib of the story here, is that they did way too much of it. There was way too much trading. There was a real explosion in retail trading. And we know from many, many studies that frequency of trading is inversely correlated with returns.
Sure.
Your portfolio is like a bar of soap. The more you rub it, the smaller it gets.
Yeah. So in this discussion, Spencer, you talked a lot about kind of the different ways people get financial advice in your book. Back to your point about really making it to where anyone's mother could read this book and understand it. And when you go to talk about this, how much would you say of good financial advice? And this is to your point about what Robinhood doesn't stop. How much of good financial advice is just ensuring people don't destroy themselves? In other words, the advice only removes the worst case scenario.
It's really an uphill struggle. I think I've had many conversations over the kind of 30 years that I've been like associated in one way or another with finance, with friends, relatives, neighbors, who will bring it up. I'm
Sure.
not out there. I'm not a financial advisor. College roommates and things like that, who tell me something that they're doing financially that I find alarming. And even though I'm their friend, or mom is their friend, or they're my neighbor, or they know that
Sure.
I've been doing this for a while and probably know more about it than them, it's very, very, very hard to get someone to stop doing something dumb when they think that they're going to be rich. And it doesn't matter how smart they are. They're doing something dumb. It doesn't mean that they're dumb. I mean, smart people.
There's nothing illegal with being stupid.
Yeah, it doesn't mean you're stupid at all, but people are very confident. That's why dentists are the classic sort of mark for a shady broker, because you have to be pretty smart to get into dental school and to get through it. And of course, then once you've been a dentist for a while, it's a lucrative career. You've got a bit of money, and so you know that you're smart. But you're smart about drilling cavities. You're not smart about picking stocks. But it's easy to fool yourself into thinking you are, especially if you've had early success. And that's why bull markets are so dangerous, because they foster confidence. I think people would be much better off doing something really boneheaded and money losing as the first thing they ever do financially, than hitting a total home run by accident.
Get them off on the right foot.
That confidence is dangerous. So yeah, I mean, it's very, very hard. Where should people get advice? I mean, that's the thing is, like, let's say we were talking about exercise, and I had an exercise plan, Cole, that was like, this you're guaranteed to be healthy, fit, and whatever, and this involves sitting on the couch and eating potato chips and not doing anything. You'd be like, where do I sign up? That's great. And let's say it worked, right? And the kind of the secret in investing is, I think for most people, is this sort of you have to save, of course. That's the first step. But once you've done that, assuming you have the discipline and the income to save, the less you do, the cheaper you are. And the less you do, the better you will do in the long run. It's just crystal clear from every serious study out there that people who sometimes will forget that they bought something for many years are pleasantly surprised. And the more often you look, and it's something called myopic loss aversion. The more often you look, the more likely you are to see that you lost money, or that you made money and then you can buy something else.
Sure.
And so even checking your investments infrequently is good. And Robinhood, we know, its active customers during the time that I described were checking their accounts 7 times a day.
That leads us right into the personifications of investing that these effectively look like gambling commercials or like a Las Vegas advertisement. Connect those dots up with the way the stimmy checks probably were closely connected to what went on with this mania.
Yeah, so you had everything was already very frothy going into the pandemic. Then you had this most rapid collapse in history from an all-time high into a bear market. You had a 34% collapse in the S&P 500 between late February and late March. And to you and I, who have savings already, to let's say a middle-aged middle-class person, that's distressing. You've seen the amount of money in that financial statement you get each month, or that you can check online, go way down. And you don't know about this pandemic. Of course, no one knew, how bad or how long it would be or how long it would take to have a vaccine. So it was a highly scary, uncertain time. But for these people who were opening millions of accounts, and the reason they opened millions of accounts is they all of a sudden they went from working or being in college or whatever to being at home, or being in their apartment with their friends, or home with mom and dad. They had nothing to spend money on. Young people, I'm the dad of 3 young people, so I'm not, I'm sorry to stereotype, but like they spend money as soon as they make it, often going out. All of a sudden they had nothing to spend money on. So relative to their wealth, which might have been negative wealth before that, they all of a sudden had savings. And then they got stimulus checks for nothing. And then they got, so a lot of them got enhanced unemployment benefits. So their liquid net worth went up a whole bunch during a time that they were bored at home, staring at their phones for hours,
Sure.
going through social media, and all of a sudden there were all these financial influencers or finfluencers who were like, hey, open up an account. And the way that Robinhood specifically and others have mimicked this gets customers is very clever. It's like a multi-level marketing scheme almost, where if you open an account, you get a mystery share of stock. Now, I would love to get a share of Berkshire Hathaway, for example, which is like $300,000.
Sure. You're not going to get that one though.
Now, they're not going to give you that for opening a $20 account, but they may have given you an $80 stock and you only put $20 in. All of a sudden, you have $100, from a $20 investment. Usually it was a smaller stock, but it was like a.
But Spencer, that's like the drug dealer getting you high the first time, right? Just to make sure that you come back and buy more.
That's right, and it's and not only that, but he'll give you another hit if you sign up a friend. Every time you bring in a friend, you get another one. And it's like it's like a sweepstakes because you don't know what you're going to get because you might get I don't know, you might get a share of Tesla if you're lucky, right?
Well, so the other thing that was different about their pricing model too, I since I'm not a Robinhood person, I'm like the geriatric millennial is what I refer to myself as. There were two kinds of accounts you explained. There was an instant account and a gold account, and maybe the weirdest pricing scheme and kind of benefit scheme that I've ever heard in a brokerage firm. So could you kind of briefly explain what the difference in those two accounts were?
Sure. Well, actually, three kinds of accounts. So you could open up an account, and the default setting, and as we know, people tend to choose the default setting and everything. There's, that's how things are designed. If you nudge, it's called the nudging people into something, and the default design was not a margin account, but it was not a cash account. It was an instant account. So let's say you're sitting, I don't know, I'm stereotyping again. Sorry, you're at a frat party with your friend. He's like, hey.
You make this sound so mature.
I'm sorry. Okay.
No, it's okay. You're speaking. You're taking my heartstrings.
Open up an account. I'll get a free share of stock, and you'll get a free share of stock. And this is really good. Robinhood is the best. I made a bunch of money last month.
Sure.
You're like, oh, okay. And then you go on your phone, and it's very easy to open an account. Of course, then you have to set up a wire from your bank, which is not that hard to do these days either. But as you know, if you've opened a brokerage, for anyone listening who's opened up a retail brokerage account, it's not like the money is there right away. It takes a few days. Most of them you have to fill out some forms, to actual paper forms, not online forms, although a lot of them have migrated online. But they made it as easy, as smooth as possible. But they also, unless you chose the non-default setting, you could trade right away. So let's say you're like, oh, I've been thinking about buying the stock. Well, if you wait 3 days before the money is actually cleared and is in your account, you might have just totally forgotten about that, or the idea passed out of your head. But since they basically said, yeah, we know the money's coming. Here's that money, trade. So it's not margin, but they credited you for your money that had not yet arrived. And then there was the gold account, which cost $5 a month, and that was that allowed you to have margin, and that allowed you to have at the time that I wrote about it, it might have changed. I haven't checked recently. The first $1,000 was on them. No interest on the first $1,000. Of course, you do the math. I mean, that's not worth it at all.
Sure.
You're paying $5 a month, and you're paying $60 a year at a time when interest rates were 0.25%. So they weren't they weren't losing money on that, but it was a way to entice you. But the first $1,000 was on them, and then they charged you at the time kind of high margin interest rates. Many people did opt for that. A surprising number. They were surprised how many people opted for the gold account. But the vast majority of people wanted the instant account, which allowed you to trade right away. So you didn't have to think about it. You opened an account and you started trading. And that played a role in this meme stock squeeze, because people who were opening accounts, there was a day that they opened 1 million accounts on Robinhood during this episode. I mean, they had 1 million accounts when they first started, which was amazing. But then there was a day when they opened 1 million accounts in a day during the meme stock squeeze.
You're touching at a theory that we've talked a lot about, and I call it, or our rough term for it is the consumption theory. And they're interesting to think about, because to your point about this free and you get excitement out of it and you use more of it. So our theory is, if you pay a fee for a service in today's internet, you consume it, right? And there's something you pay for, you consume it. if you don't pay a fee, it consumes you. The theory seems to fit almost perfectly because to your point, even when they paid, they were getting something free, which was, $1,000 of margin. And the reality is it was going to consume them nonetheless because of that free thing. Would you agree with that as you look at other places? I mean, as we move outside of Robinhood, I think of like, what are things that draw me in on the internet in digital ads and other things where I'm not paying anything? At the same time, is it consuming my time, which is worth real money?
Yeah, I think that the same thing is, it's a cliche by now, with social media. If you're not paying for it, then you're the product, right? And I think this very same thing applies to Robinhood and other brokerages using that business model, because if you're not paying, then they're getting the money somewhere. In the case of Facebook, they're getting very useful information about you to advertisers. All the pictures of your kids and your family and all the social connections. They have a tremendous amount of data. Data is the new oil, right? And so they're getting very useful stuff, even though no one would ever think to pay for Facebook. But then people also don't stop to think about how it's this tremendously, well, not recently, but, tremendously profitable company, and other social media firms as well. And I think the same thing extends to this. Think about how people are getting paid. You should, whenever you deal with someone financially, you should think about how they're getting paid. And in my opinion, you should prefer people who get paid on the back end, not on the front end. For example, I have to be a pretty big fan of robo-advisors for young people who have too little money and who are cyber savvy enough to have an algorithm, basically to send their money to, something like Betterment or Wealthfront, and there are a bunch of other ones, and then have it manage a portfolio of index funds for them. I should get commissions for those guys. I've sent so many young people to, just said you should find a robo-advisor and given them like just a list off the top of my head. And I think it's a really good thing, and they'll manage your portfolio. Well, those robo-advisors are generally pretty good, but like a normal financial advisor, that's a human, they do well when you do well. They do better when you do better. And it takes a long time to make money. As a matter of fact, you initially lose money on a customer. You have to sign them up and set things up. And then, the relationship should be profitable for customer and advisor. That's really the way things ideally should be. If you're dealing with an honest person.
Charlie Munger calls it ignorance avoidance, I think is what you're getting at there. Explain what loss porn is on the Reddit forums.
Well, loss porn is very interesting. That was a real revelation to me as well. I'd looked from time to time but not enough, at Wall Street Bets until I spent a year living in it. And loss porn is, think about, I don't know, the way that, and I've got a couple of them in my house, men in their young 20s behave around their friends, and that, let's say they do something and then they fall out of a tree or something and get hurt, but not too badly. It's hilarious, right? It's really, really funny. It's they did something reckless, something bad happened. They didn't die. Maybe they broke a bone or got a bruise or whatever. And if it's on video, it's like it goes viral, right? Of someone doing something dumb. That's why Jackass is so successful. And on Wall Street Bets, people had this real ethos of openness. Of course, you could never know if things were real, but you had people who would live stream, like they would bet on some discrete event, like Apple earnings. There's a kind of an infamous video on there of someone betting his entire net worth on options, put options that were expired right after Apple earnings, and then losing everything and having a nervous breakdown on video. And I have a screenshot of it in my book of the video. I mean, I shouldn't be laughing, but but that was kind of that is cool. So even if you go on and do something, the knowledge that if you do something crazy and it works, well, money is nice. You made money, right? You made a lot of money from a little bit of money. And if you lost all your money, well, you didn't have that much money in the first place, probably. And you can post a screenshot of it, and then you get kind of street cred or social credibility on this network. So yeah, that's what loss porn is.
You do a wonderful job of explaining the history of brokerage commissions in your book. Start from pre-75 and walk us quickly forward on this subject now.
Sure. Well, you all should know or should read or be familiar with a book called Where the Customer's Yachts, written by a lapsed stockbroker named Fred Schwed. Very funny, probably one of the funniest book, I think, about Wall Street. And it's totally accurate today, even though it was written in 1941. And it's really about, like, why, and I guess Warren Buffett has a quote, along this line, Wall Street is the place where people in Rolls Royces get advice from people who take the subway. But but what he pointed out is, like, this old anecdote that dates back to maybe the early 20th or late 19th century is, like, someone went to Wall Street when there was a marina down there and admired all the nice yachts. And so who do they belong to? And, like, they belonged to the brokers. They were getting so rich. So Wall Street was a small, clubby, really lucrative place. You had to have a lot of money to play there, and then it was very expensive to transact. So you see these, I've written about it, and but you see these charts, like, if you had invested $1 in 1926 and just held on, you'd have $10,000 or whatever, and buy and hold. Well, it's not really accurate, because you couldn't do that. Even reinvesting dividends cost money. Certainly buying another share of stock cost a lot of money. Wall Street was just a really, really expensive place. You had to be somewhat wealthy to play. And then brokers had these fixed commissions until 1975. Finally, they were just forced to give them up. And that it took a few years, but then you had the rise of companies like Charles Schwab that were discount brokers that made it much, much cheaper for mom and pop to transact. It really wasn't worth the trouble of brokers for, like, a person with a little bit of money to be their customer until discount brokerage came along. And then it $50 and $30. And then, by the time of the dot-com era, it was $10 or $15. Then in recent years, prior to the pandemic, with the exception of Robinhood and those kinds of companies, it was $5 to $7 to trade, which is, just dramatically cheaper. And it became cheaper because you weren't, you used to trade in eighths of a dollar. Now you're trading in pennies, right? So it has become much cheaper to transact. And you have, of course, index funds, which I'm a big fan of. You can buy SPY and basically own the S&P 500 in a very tax-efficient package for 0.03% a year, or the total stock market index, or whatever, right? Or a bond index, pretty cheap. So the cost of transacting on Wall Street has come down by orders of magnitude.
So you really advocate in your book, to your point, for passive investing at times. But in our discussion today, you've pushed a healthy amount of skepticism, I would say, for the returns that are begotten out of this mania. So I'm gonna mention something, and I'd love for you just to kind of comment, because I think you're getting at what could almost be almost disagreeing arguments. But so we look at St. Louis Fed data, and they have a wonderful data point in the St. Louis Fed, and it gets at, you mentioned psychology at the start of our discussion. It's called equities as a percentage of U.S. household financial assets. And the data set goes back to, like, 1952 when the Fed began recording it. And why we like the statistic is because at high points in the statistic, it's a nightmare for stock investors. And at low points, it's a dream, because there's an inverse relationship between the ownership of stocks by U.S. households and the forward returns. So I say that because, someone reading this book, I agree with you that there's a lot of people that aren't going to be good investors. That's why for people that are, it could be so profitable. At the same time, at a juncture like today, we just came off the highest ownership of equities ever in that data set. And if you look at the correlation, it argues that there's either going to be zero returns or possibly negative returns beginning in 22.
A low-cost CD might be the winner the next 10 years.
So I guess so track with me here, because, like, you have a healthy sense of skepticism of what's going to go on, and, like, we agree. I mean, like, everything you're saying earlier about the lows aren't in. You're right. But the passive S&P isn't the way to succeed in this era, if you're right about that.
Temporarily, just in some phases.
So I work at the Wall Street Journal. I can't, just because of my job, I edit things about so many companies. I don't own individual stocks. I wish that I could, because I'm fascinated by investing. I really love writing about it, talking about it, thinking about it. I have all kinds of paper portfolios that have been running for years. That of course a paper portfolio is easier than a real one. I'm a genius on paper, but it's harder when you actually have to do it with real money. I acknowledge that. I think that I'm a columnist. I can go ahead and say this. I think that you're basically correct in terms of like a 60-40 portfolio today, even with bond yields having spiked a bit recently. You probably make very little money. You'll after inflation, like you'll make zero or negative.
If we add inflation, by the way, let's just say this is a 70s style era, even then the S&P made mid single digits. It was like almost 6%. And after inflation, it lost 4 to 5%. And given, like, if we go to that St. Louis Fed data, it would argue it's probably negative returns if the data correlates like it has in the past. And that's before counting the inflation we just saw. So I agree with you. I mean, we're huge fans, Spencer, of common stocks. Like, we love common stocks. They're the greatest thing since sliced bread. I was born owning stocks. I'm going to die owning stocks. It's just such a great thing to do, to your point, to be a participant in this great American success, right? No question. At the same time, there's no guarantee in a 10-year stretch that anyone gets out alive after inflation.
No, there isn't. I mean, and this is, obviously is departing somewhat from the thesis of the book, but of course I am a big advocate of passive investing. But look, the way that, first of all, you don't know that. That's what the math says, but the math could be different.
Correct.
For example, if you want to own what's less bad, right? If your investment universe is limited to a variety of passive vehicles, let's say, and someone said to me, well, are we going to have deflation or inflation in the next 10 years? What's more likely? Well, obviously, some kind of runaway inflation is the tail event, right? It's just on the extreme, more than we've had now. I mean, I think there's no question that's the greater danger. So what do you want to own? Do you want to own assets or do you want to own liabilities? Well, I think being, especially if you're young, anyway, but especially now, being more stock heavy makes sense. Second of all, the way that most people invest, they don't have a lump sum that they inherited from a rich uncle, and then they put it into the market and hope that it's worth more in 10 years. They're saving every month. And so we're going to have probably lower lows and maybe much lower lows in the next 10 years. And you don't know when the lows will be in because it's unknowable. It's fundamentally no one, people opine all the time, but no one can really predict that. Anyone who could predict it wouldn't say, right? You're going to be investing at much lower valuations at some point, probably in coming years, and that at much more attractive valuations.
Dollar cost averaging is what you're talking about.
You're saying it's better to be a millennial than a baby boomer right now.
Right. I mean, so yes, clearly you have to, and that's your expertise, not mine, but you have to consider when you need the money, what your situation is, if you have so much money that you're really just going to sort of, because like, for example, there are 80-year-olds for whom it's advisable to be, they have so much money that it's advisable to be all in on stocks because their money is basically for their grandchildren to inherit. So their time horizon should be their grandchildren's time horizon. Like there's this sort of, your age, minus whatever. That's just a very crude rule of thumb. Everyone has a different situation. But if you know nothing about stocks, and most people know nothing about stocks, and they don't need to be an expert on stocks. I don't think that getting, I happen to like it and enjoy it, but most people's eyes glaze over. You know that. I mean, you go to talk to your friends who are outside the stock market, and beyond the what should I buy, they don't really want to get into the sort of the really important kind of minutiae of investing.
Here's the irony, and like I said, we're stock people, and everything about this discussion's fun, and we loved your book because it's all about stocks. But the funny part is, as the stock people, if someone put a gun to my head, Spencer, and said, Cole, you get the S&P 500's 10-year return, or you can buy a 10-year treasury today, I would buy the 10-year treasury because I guarantee I get 4, right? In other words, that's a great return, I think, all things equal.
I take the other one, honestly, because let's say, you're guaranteed to get 4, but you don't know anything about the purchasing power.
Well, but you're going to lose purchasing power on either investment, right? You're going to lose it on either investment because of inflation. It's going to erode the effects.
No, because that is a tail risk that you can hedge for. So because people think about the 1970s as such a terrible time, of course, you had two energy crises. You had a lot of other issues, and you started out in 1966. You had very high valuations. In 1982, the Dow Jones Industrials were at the same exact price, but at very low valuations, right? So you actually did have earnings growth, and you had rapid inflation. It's just the stocks went from one, not extreme, but very high level to
6 times earnings. 6 times earnings at the end.
Yeah,
6 times earnings.
Right. And so people think of that time and they automatically associate inflation with poor equity returns. But that's actually not true. If you look at the 19th century, inflation was almost uniformly good for equity returns. If you lived in Zimbabwe, and I'm not saying we're going to go the way of Zimbabwe, but if you lived in Zimbabwe, there were years when Zimbabwe was the best performing stock market on earth in nominal terms, not in real terms, right? So what would you rather have owned? A Zimbabwe central bank note, assuming they would actually honor it and pay you back over the period of that 1 year, or Zimbabwean stocks? Well, clearly stocks, because stocks are companies with assets that are real, with liabilities that also get whittled away with inflation. And so if the tail risk that you are worried about, and it is one that I'm not saying that it's going to happen, but it's one that I'm worried about, is some kind of very rapid pickup in inflation. The Fed says, hey, we're going to stop this tightening because we're driving the economy off a cliff, and some kind of crisis emerges. Inflation might become the norm, right, for a while. And so in that case, what's the less bad thing? Obviously, you don't have to choose one investment or the other, but I think it's foolish not to have some significant equity component in your savings, given the possible future outcomes. I mean, better to have 80% of your real purchasing power after a decade than to have 20%, right? So, and that could happen. It's not impossible that would happen. So that's this is obviously straying very far from the book, and this is just my personal opinion, not that of the Wall Street Journal or anything like that. But
sure.
That's how I see things, and so obviously I'm not 100% in equities. I'm about to turn 53. I do have, my time horizon is somewhere between you and your dad, I guess, but yeah, I mean, that's, and I've kids still to go to college and all that stuff, but equities are not too bad. Of course, I think I agree that they're at a very high historical valuation, for sure. But what can you do? I mean, you can buy value stocks, which I do. I buy, all kinds of value funds. So I look at my funds, and if I see a Tesla in there, if I see whatever, in the index, then I don't buy it, don't own it. Although, funnily enough, I own an index ETF that owned both AMC and GameStop, but the two stocks I read about here, for a long time. And that's because this is like the dumbest thing, like they were the two biggest holdings in the
Russell 2.
Or small cap value fund, sorry, because they had appreciated so much. So I owned a little bit of those indirectly, but.
So Spencer, we didn't talk about. I just wanted to mention some things for the listeners. We didn't talk about the option pricing and how the gamma affect prices, which I think you do such a good job in the book. We also didn't talk about Ken Griffin's cozy relationship with making money on these folks, and at the same time feeding money across the hedge funds that were getting destroyed. So I again, like I said earlier, I think you do such a great job of talking about this to the layperson. I really appreciate you joining us today. If you want to understand the power of a mania that is once in a generation, I would argue, you need to get a copy of Spencer's book, The Revolution That Wasn't. It's such a good read. I highly recommend it to understand the meme stock craze of 2020 and 2021 and people like Keith Gill and Chamath and all these people we've talked about. For our audience, if you have a great book that you'd like to recommend, email podcast@smeedcap.com. That's podcast@smeedcap.com. You can also send your suggestions to us on Twitter. Our handle is @SmeedCap. Thank you for joining us for a Book with Legs podcast. We look forward to the next episode.
Thank you for listening to A Book with Legs, a podcast brought to you by Smeed Capital Management. The material provided in this podcast is for informational use only and should not be construed as investment advice. You can learn more about Smeed Capital Management and its products at smeedcap.com. or by calling your financial advisor.